Now, my pleasure to have with us here today John Cassidy, How Markets Fail, the Logic of Economic Calamities. John, welcome to Traders Nation. How are you today?
Good, thanks. Thanks for inviting me on.
Good. Hey, John, with the string of denial and bad decisions to the disastrous illusion of harmony of the Great Crunch of 2008, what happened here?
Well, my argument is that, this wasn't just an aberration. There's a sort of tendency towards these type of events in modern financial markets.
Yeah.
Speculation, can tend to get out of hand, especially when the Federal Reserve and the other authorities, don't do anything about it. I mean, I think it was self-interest on the part of the banks and investors and homeowners, etc.
Sure.
When rampant credit creation is involved, that's going to create problems, and so pretend that you can rely on the market to solve that is I think, a mistake.
John, can we rely? Okay, now you say it is a mistake to rely on the markets, but you hear that's the battle cry everywhere. Let the markets take care of itself. I mean, isn't the markets like natural water? Won't they find their own level at some point, John?
Well, I mean, you have to distinguish between different types of market. In my book, I go all the way back to Adam Smith, who was the founder of the sort of invisible hand theory.
Yeah.
I think that free market theory works for sort of normal products like cars or meals or both services, sporting goods, things like that.
Yeah.
But when it comes to finance, those rules don't really apply. And actually, Adam Smith himself was very suspicious of banks and uncontrolled credit creation.
Yeah.
Because once you introduce the speculative motive, that is an element which is not in play in a normal market for cars or golf clubs or whatever.
Yeah, John, is there room for another market? I mean, is there?
You mean another bubble?
Yeah, no. Well, of course, I think there's going to be another bubble because we have a hard time. We have a hard time realizing the mistakes of our previous bubbles that we've had in the last 10 years.
Right.
But I mean, is there room for another market outside of the free market? Meaning?
Oh no, I'm not trying to get rid of free markets. I mean, we've tried getting rid of free markets. It's called socialism and communism. It didn't work. My argument is that you have markets, and in most industries you let them carry on and do the good that they do.
Yeah.
But in finance, you have to have a different set of rules.
Sure. All right. You know what? I absolutely agree with that because there's a lot of creative stuff that goes on out there that people and investors buy into. I think a lot of that should be cleaned out. But nonetheless, I think you're right. Hands off on the free markets. The free markets need to really work their own way. So let's talk about self-correcting. Do you think we'll get back into a reality-based market then?
Well, I mean, the problem is at the moment, it seems to me we're creating the basis for another sort of speculative episode. We've got zero interest rates, basically free money financing these enormous carry trades. It seems to me the Fed, I don't blame them for bringing interest rates down to zero, but I think if they don't change policy pretty soon, we're going to make the same mistake we made after the internet bubble.
Yeah.
And, we're just going to be popping up another bubble. What it's going to be in, I don't know. It might be in gold or commodities. Who knows? Even real estate could come back with mortgage rates so low,
Sure, John. We had the bubbles that really the consumer, the main street, has suffered from that in the last 2 or 3 of them that we've had since 2000, 1999, 2000. But now you're saying, and we talked about this yesterday, where the next bubble is it the federal government bubble? Because the federal government cannot continue to keep spending and printing money like it's doing. It is in itself creating a bubble, and Main Street, it really has no control over this right now. Is that the next big bubble? And how critical?
Some people do argue that, there's a big bubble at the moment in government bonds. They certainly, got very low yields and governments issuing them at historic rates. I certainly wouldn't, think that U.S. T-bills are a good investment at current yields.
Yeah.
It's hard for me to see how that's going to produce a sort of economy-wide, speculative mania like we had in real estate or in stocks.
Right.
But certainly, I think insofar as the bond market goes, sure, there might be something of a bubble there at the moment.
Yeah, all right. John, you talk about, in how markets fail, you talk about utopian economics and also, of course, reality-based economics. What's the difference between the two?
I think the difference is really, a matter of attitude. A lot of economists in recent years have tried to apply these idealistic models of how markets work, a lot of them very mathematical, to markets where they just don't apply.
Right.
I think practitioners, people on Wall Street, your listeners, people who work in the industry, they never really thought that markets were perfectly efficient or that they couldn't get out of whack if there wasn't some controls on them. But once you operate in the environment you're in, and if you're in a deregulated environment with very cheap money, you're going to ramp up the risk, and you're going to take more. You're going to get involved in complicated trades and risky trades.
Sure.
As I say, that's what I refer to as a sort of rational irrationality. It's rational to be irrational if you're in one of these markets, and the only way you can stop that is by having some form of collective agreement enforced by the government, I think. I mean, people don't like to hear that, but I don't really see how there's any alternative.
All right, to get away from that, they're going to start raising interest rates. Money's not going to be cheap, then what?
Well, I think that's going to be a good thing. Obviously, if they raise rates too quickly, we might go back into a recession.
Yeah.
But I think for most industrial, people who are actually investing in real capital as opposed to paper, I don't think the difference between 0 and 2% interest rates is that much. Right. I don't think there'd be any danger of derailing the economy by raising interest rates to 2 or 3%.
Well,
but what you would do is, stop a lot of these hedge funds and what have you doing their carry trades, which, as I say, seems to me to be stoking another bubble.
Well, John, the percentage from 0 to 2 may not seem like a lot percentage-wise, but what about the signal or the message that it may send? Doesn't that drive a whole different herd?
Well, it's a different question. I think if if the Fed could tell people that they really believe in this recovery and that they think it's safe enough to raise interest rates, that could actually have a positive impact. I mean, at the moment, what we've got is firms are not hiring because they're not sure whether this is a real recovery or whether it's just all the government.
Right.
If we do get another quarter or two of solid growth, I think the Fed can then say, look, this is a real recovery. We don't need the emergency medicine anymore, and we're going to start removing it.
Well, John, then you may agree that the Feds aren't convincing in not making confidence out there in the markets, right? I mean, they're not convincing. We got to find real numbers, not fuzzy ones, that change almost on a daily basis. We need to find confidence in the real markets out there.
Yeah, well, I don't think anybody's going to really believe in the recovery until it feeds through to the labor market and we get a turnaround in employment.
Right.
I actually think that's going to come myself. I'm not as pessimistic as some other people. I think if the economy keeps growing and demand keeps going, then companies will need more workers and they'll hire them.
All right, we're out of time. How markets fail. John Cassidy, thanks for being with us today. Appreciate it. All right.
Thanks very much.
Stay tuned. We'll tell you how to get a copy of this book on the other side.